this market is getting interesting. So we got the sell-off that we've been looking for, continued this week. We have started to see a few signs that we might be getting close to this crescendo that I've been talking about. So we got the VIX spike towards 20. We touched a 19 handle yesterday. That's good enough for me. A material repricing in skew, so 50 percentile back for the S&P 1 month, $25 skew. Implied correlation on this chart, you can see 3-month implied got to super low levels, which we flagged, historically low levels, I'd say, in the teens. We've had a decent pop back towards 30. Now, the truth about correlation is we have got to ridiculous levels in correlation throughout the course of this year. So correlation used to trade in the kind of 50 to the kind of 30 to 50 range, but it just kind of broke out that range and just went super low this year. So it does have room to go back above 30. So it's not a given that that is a big enough correlation spike. But arguably the structure of the market has changed. There is just a ridiculous amount of supply of index vol relative to single stock vol, and we may not get back into those ranges. But generally, when you see implied correlation spike by a material amount like this, it is a bit of a sign that the market has got a bit more panicky. Okay, and I would also say that the lows that we got to in correlation are a function of not only index supply just generally, but also a lot of hedge funds have started with the mandate to specifically sell correlation, right? Because it's been a trade that's been working. And so what tends to happen in these markets, when things work, more people have a mandate to do them, more AUM chases the same trade, and it pushes it to a silly level. And now you might need a bit of an unwind of that type of correlation trade, the dispersion trade, where some of these guys have entered into stupid levels and they need to get kind of washed out. Okay, so that's something to be aware of. Realized correlations also increased. You can see that by these breadth indicators dropping down to the year sort of lows. This is number of members of the S&P above their 200-day moving average. So that's dropped down to around 40%. This has also coincided with kind of bottoms in the market. If you look back this year, March and kind of early summer were areas where you would have done well to buy the dip, basically. Okay, so I think all these factors are lining up to suggest that the correction that we're currently undergoing may be reaching its conclusion soon, if not already reached it yesterday. And as a result, we've taken some profit on some bearish long vol positions, and we are kind of now going to use the next week or two to enter trades that will do well if we were to start to see vol come back down and markets to rally again. Okay, trying to gear up for that year-end rally, as I spoke about in our weekly video for subs on Sunday. Now let's jump into the VIX in a bit more detail, right? So since the September monthly expiry, we had said the gamma unpinning of the market would probably lead to a more bearish tone. Russell was leading the way to the downside. It didn't have as much gamma positioning that was artificially holding the market up, whereas NASDAQ and S&P did. Once that gamma positioning expired, we started to see a move down. We started to see a move up in vol. You've seen the VIX go from 13 to 19 in a matter of 2 weeks. That was pretty much our target for that type of move. And the VIX seasonality has pretty much worked to perfection. Okay. So now we've hit the top of the range. For us, it's done enough. That doesn't mean it can't go higher, but it's definitely done enough that it could now start to calm down. You've seen the VIX curve pop, obviously, here. And what happens when this curve tends to flatten, the opportunity, if you haven't got the appetite to just outright sell vol, then the opportunity is to trade calendar spreads in the VIX futures or in the option space, okay, to try and play a normalization of back to some sort of contango in this curve where the front end is the one that gets hit hardest, okay? That is the normalization trade that I like to play because VIX gravity is very much a reality. And so when the VIX does spike, you want to find ways to capitalize on that gravity. So how am I doing it? You look at our dashboard, bearish risk reversals, selling calls. I wouldn't touch that with a barge pole, right? This is why you need someone with a bit of experience so you don't blindly follow the strategy compass, because the strategy compass will say vol's high, vol of vol's high. Obviously, I have to sell calls on the VIX, right? You do that trade, yes, it will work 9 times out of 10, but the one time it doesn't work is going to blow your entire account up, okay, which you don't really want to do. So how can we do the same thing? How can we capitalize on the VIX coming down without taking any risk of blowing ourselves up, right? That is the trade that I want to do. Now you can see the term structure's gone crazy inverted. So the front end's gone very expensive, over 100 implied vol. So I don't really like buying October VIX puts right now. Not only is the vol expensive, October's not that far away, right? These things are going to expire in 2.5 weeks, 2.5, 3 weeks. Is that long enough for the market to find its bottom, rally out of it, and for vol to get crushed? I'm not sure it is. So, and also, if we go further down the curve and buy November puts, we get a much cheaper vol. So what I like the idea of is you buy the November puts in VIX, and then you sell some December puts against that to get the premium back in case that the VIX spike keeps going and you don't want to just get carted out on the premium that you spend, basically. Okay, so that is the idea. So in a bit more detail, the actual trade here, you can see